oil has the potential for a large drop. The E-mini has the potential to keep on moving up. So I just want to talk about a few different markets in this video and just kind of see where we're at. Here's one position I've been holding. I think the market, the S&P 500, I think our stocks will continue to work their way up. Now, I have this profit target at around 6,500. So here's the daily chart. Getting closer to that 6,500 level. I'm pretty sure we're going to get up there. I mean, this week, it looks like we're going to probably pretty quickly move right up and get to that level. Beyond that, I see this going, just continuing to trickle up with occasional pullbacks, kind of like we had a couple weeks ago. You know, occasionally we'll have a week that's bearish, and then we'll probably just continue to trickle up. So I would not be surprised if we just do this up to 7,000 or even beyond. And let me zoom out, and it'll kind of put this all in more context. You know, as we zoom out, the market has been very bullish in the last 2 years, as we can see on the chart here. And then move up to 7,000, it's just that distance on the chart. All right, it's actually a fairly small move compared to the total size of the chart. When you zoom in and you think of it in terms of a percentage terms, that would be about a 7 or 8% increase. And yeah, I mean that's a pretty strong move up. However, these moves are common. I mean, if we take this distance and then move it down, we've moved up that much since May, and we do it again, we were just a few weeks in that distance. So we've actually moved that 500 point distance 3 times already. 3.5 times since April, we've already moved this distance up. And, around this time, you're going to start hearing people get real bearish. The bears start to come out of the caves if they hadn't already. And, they'll say, oh, the market, can't do this forever. It's gone on too long. And actually, usually it tends to continue to go on longer than you would think. If I zoom out again, do a measured move of the tariff lows we had. And that measured move puts us up even beyond 7,000, actually puts us up around 7,700. Now, that is a farther away goal, but honestly, I mean, really, that's where the market is looking at. That's what it's eyeing. I mean, that's going to be an important target. I wouldn't think this year, but I mean, next year and the next couple years, that this area up here is 7,700 with that very obvious measured move target. That's going to be something to keep an eye out for. Some more positives of the market. Russia, Ukraine is probably nearing an end. Interest rates are probably going to start lowering soon. The trade tariffs are in general starting to get settled, and companies are continuing to innovate even at a faster pace. So we have a lot of really good things for the market and a lot of reasons to stay long in the market. So I might even be able to get this profit target today, but since I do want to continue to try to hold long in the market, I'm going to go ahead and move this up, and I'll move it up to right below the 7,000. And you can see I have a stop lower down here. I really don't intend for that to get hit. That's just there so I can have my bracket order. Any dips with this, I would intend to just hold on to the long position. And really, I think this is a great way to utilize some of your capital, is trying to do like a long futures contract like this. And when you have these dips in the market, these weeks that are down, then maybe add on to it or just hold through it. And then if you look a year later, then suddenly position is way up, and you really didn't do anything. You just had to manage it 4 times throughout the year to roll forward that contract every 3 months, and then that's all you had to do. So it's nice to have something like this where the market's just always kind of working for you. And yeah, there's going to be pullbacks, but the position is not too large, so the stress is not going to be too large as well. Okay, I don't know if I was kind of rambling there, but let's go down to the 5 minute, and I want to look at the price action we've had for today. So the open, this is a very common pattern for something that's going to end up as a bull trend day. So basically, we have an attempt to go lower down to the moving average. This is just a form of an opening reversal. Now, the trouble with trading the open is that you might be wrong 2 or 3 times, and then the market goes in your direction. There's so many reversals on the open that you can really get mixed up in the open. You can be betting on the right direction the whole time, and then right when you stop betting on that direction, then it ends up going your way. So what are some of the bets that one might take long? Well, gap up, bull bar, and then a second bull bar. That's a reasonable place to try to enter for a swing trade. You're buying here, betting that this is going to be the low of the day, and then we're going to have a big trend up. So I zoom back to August 4th, and here's an example of that. Bull bar, then you get a second bull bar. And if you buy above that, then you end up with a day that basically trends up the whole day, and then it closes on its high over here. So people that are buying above this, that's what they're doing. They're basically betting that they're going to have a large bull trend day, and let's say they risk their 10 points. Well, they're betting they're going to have like a 50-point day, right? And then so in this case, they were wrong initially. Bull bar here. I would not want to buy above this because we might get a second leg down off of these two bear bars here, and we've not created a wedge bottom yet. Then you get this second entry long here. Now that's the better swing trade of these two. So trying to buy here, now you have a wedge bottom, you have a double bottom, and a second entry long, right, with the first entry here, then a second entry. So your 2 buys in the open, you lost this first trade, and then this second trade would have done quite well, and the whole day has just trickled up in this small pullback bull trend. So at a minimum, if you're buying here, try to go for 2 times your risk, and then that puts you up here, and that would have easily offset any loss you would have had over here. Even if you put your stop below the bar 1, then this would have ended up with a pretty big profit. And probably 2 times your risk, considering the larger context of the bull trend we're in, and just the context from this day, you could probably go for more than 2 times your risk. So maybe only take half off at this, and perhaps do a measure move up from this opening range. So then you might try to hold the rest up to here. So at what point did this day become a bearish day where it would be okay to try to take a bearish trade? Is there any point like that? I would say no. And so what does that tell you? If you look at this chart and you say, yeah, we never really saw any reasons to get short at any point. Maybe we saw a reason to exit a long trade, like maybe here, but we never really got a reason to get short. So if you're getting a day like that, then you need to try to really be focusing on just being long. If you're not getting reasons to short, then just buy, and then try to hold that, try to swing trade and hold that for as much as you can. Some people might do the scalps up through here, which is kind of more of my personality. Others might trade smaller and try to buy like down here, or buy above this, pull back here. So 6 bars up, pull back, buy above that, try to swing trade, and just try to hold until the market's clearly not going up anymore. So that's kind of a general idea that you can put into practice. If you say, yeah, there's not really a reason to get short, so forget about getting short. Don't try to be at no point was it bearish, or at least bearish enough to get a trade in. So you should not be trying to slip in a short trade somewhere. So that being said, now that the first thing's out of the way is if it's going up, don't short. The second thing is, so what are some more of the entries for getting long? So we've identified 2. These are that opening reversal type of trade. And then After that, once you identify what the market's doing, you're basically just either holding your position or you're waiting for pullbacks. So like here's a pullback, for example, 6 bars up, pullback. Now I wouldn't buy above this one for a scalp, but if you're betting that the day will be a bull trend day, then this would be okay to take. Trying to buy above this bar or above this second bar. I'm more inclined to buy above a second bar. Why am I usually more inclined to buy above a second bar? Well, because we might get a quick second leg off of this first pullback. So this bear bar is a pullback. Then we might, after this bull bar, we might try to go lower one more time and trap out those traders before it heads up. So you basically have a double bottom here, and then the market goes higher. But now if you get a second bull bar, then that kind of increases the chances that, yes, this was just a pullback and we're not going to get a second leg down off of it. So like this second bar, this would be better for a scalp as well. While if you're buying above this first bar after the pullback, then you really should only try to be doing a swing trade off of that. Okay, so market's going higher. We have the high of the open. We break above that, pull back, then continue higher, pull back, then a bull bar. Now let's say you buy above this. Then the next bar is the bull follow through bar. Okay, that's good. Then a doji bar, then a bear bar. Okay, so what do you do now? We have two options. You can hold with your stop either below the bar. Maybe your stop is also down here, which is something I talk about in the course, different ways to manage your trades. Let's say your stop is here, then if you're buying above that, one option is to hold with your stop. So you just put wherever your stop is, then you just keep it there. Or you're disappointed by this. You're saying maybe this is a double top. We're far from the moving average. Chance we might have a pullback there. So you could take a small loss below that bear bar, and that way you would avoid a larger loss. And then so now you're out of your position, but the market keeps on going up. And if it keeps on going up, then you can re-enter. So market tries to go lower again here, then pull back. So then you buy again above either this bar or maybe that second bull bar. And once again, these two bars kind of have the same principle as I talked about down here. If you're buying on that first one, swing trade, but that second one has a higher probability and is more likely to work as just a scalp. Bears struggling to get anything going, and bulls able to continue to make gaps. So we have the high of the bull bar. Next bar breaks above it, and then the pullback on this third bar does not come back to the top of the first bar. So imagine any bears that had sold above this bar. Their entry bar became a bull bar, and then on this pullback, it didn't even get back to their first entry. So they're selling here, and the market wasn't even able to pull back to their first entry. So that's a gap. So the bears that sold there, suddenly they're trapped into shorts, just like they had been all day. And so these little signs of gaps, and we have another one on the next bar, these little signs of gaps are signs of continued strength by the bulls. And so that's a sign that the bears are so weak and you want to continue to try to buy. So pull back, bull bar, try to be buying above that. So you can see there's different ways to trade days like this. If it's going to be a bull trend day, try to buy early, maybe take a couple losses, try to not have too large of a loss on the open and try to get a big swing trade and just hold it the whole day. Or you do some of these smaller trades where you just kind of scalp throughout the day, and you keep your losses small as well there. So if you're buying and you think you're wrong, then you just get out and take a real small loss, like a point or half a point, and then re-enter, and you can just take multiple scalps like that throughout the day. I think that's easier said than done. Actually, the easier thing is really to try to catch an opening reversal and just hold it the whole day. But really, you need to just find with your personality, what works best for you. All right, next I want to talk about crude, the crude oil futures. So this is the daily chart. And to me, it looks like we're at risk of collapsing here. So we had this big sell-off, which was from the B-2 bombers striking Iran. And then we're kind of in this bull channel, this week move up, this week attempt to go higher for a few weeks. And then now we're selling off pretty sharply. It looks like we could be setting up for a collapse below this current low right here. And the next level would be down around here, which is around 57. So $57 a barrel. Before I was saying that I'd be interested in buying around 62. But now I think if we go below this level, we could start to move down pretty quickly and actually get down to around this 57 level or lower. So I'd rather, if I was going to do that, I'd rather try to buy down near this level instead, because I have a feeling I don't think this range here is going to hold for too long. I think we're actually probably heading lower. And what's telling me that is we have these three fairly strong bull days, and then it just disappeared. So we had this buying, people were buying above the bars up here, and then now they've just gotten crushed. So a lot of trapped bulls trying to buy crude up here, and in theory they'd be exiting over here, especially if it can get down below this level. So as I'm saying that, and I'm developing a bearish thesis for the next few weeks for crude, then I would be inclined to go to watch crude and try to find short trades on that. So this is one way that you can look at a longer time frame on whatever market you're interested in, try to find the bias on it, and then that allows you to watch for trades during the day if you're watching it during the day. Kind of like over here where it's above the moving average. So if you determine that you have a bullish bias, then probably you want to only look for those long trades. So on your lower time frame, when you're watching it throughout the day, if you have a bullish setup, then that setup probably has a better chance of being in your favor. So I like to think in that way, and having that confluence on multiple time frames, not only is it just good practice, but actually helps guide you in finding your entries. Right? It makes a lot of sense. If we think crude is going down, then that any kind of short we would take on a lower time frame, that would increase the chances of it. All right, guys. Hope all that was helpful. We had an interview with Jay Ratliff. That was the previous video. So if you haven't seen that yet, go watch that. And if you guys wanted to see me do interviews with someone else, let me know, and I'll try to reach out to them and see if we can get an interview going and get to know them. So guys, thank you for watching, and see you in the next video.